World record holder, you've written 19 books on real estate.
The warehousing piece is so large.
And you have the concept of a sponsor, you have the concept of a manager.
So fractional ownership was mushrooming like chit fund.
How does a REIT make money?
You would be surprised. Pakistan had this way before us.
It is 96%, right?
Absolutely.
I was looking at that and everyone around me was like, not possible.
WALE, W-A-L-E. So weighted average of lease expectancy.
What is the limit by SEBI?
In India, you need a scam to happen before you have a regulation.
What is the other difference between the regular REIT and the SM REIT?
They have a prison REIT.
Prison REIT?
So now this will bring much more democracy into the entire setup.
The biggest challenge in real estate today?
I think this one criteria will knock off 80-90% players.
In the US, like what percentage of real estate is owned through REITs?
REIT market is a 86,000 crore market. India, the penetration is below 20%.
Do all REITs have to be listed?
The way FSI is panning out, I mean, suddenly you see India becoming the high-rise capital of the world.
The most fun book you have ever written?
We eat, sleep, breathe real estate.
Harshul, welcome to the PropertyAngel podcast and thank you for joining us. You've come all the way from Mumbai, so really appreciate the effort. Today we are talking about REITs and the timing could not have been better actually given the recent SM REIT announcements. And you have of course done a whole Ph.D. on REITs, and amongst all your other accomplishments, you are a seasoned developer, you are a chairman of CREDI, Stats and Research, and a world record holder. You've written 19 books on real estate, which I must say I have read the one on FSI because we had a podcast on FSI recently, so I used that for my research. But I would like to start with the basics like we usually do, and just from a layman's perspective, if you had to explain what a REIT is, how would you explain it?
So, REIT from a layman perspective works like a mutual fund.
Okay.
So what happens is you don't have the expertise to invest in the stock market. You don't have the expertise to track it on a daily basis. Switching the portfolio becomes cumbersome. Real estate is even more complicated in a sense. And it requires that technical skills. Plus, vis-a-vis the stock markets, real estate requires a huge ticket size for you to invest. I mean, crores of rupees are required. Now, what REIT essentially does is works on a mutual fund concept. So just like you invest your money in a mutual fund and the fund manager will invest further into a stocks script, here you invest money into a REIT fund. So REIT stands for Real Estate Investment Trust.
Yeah.
It's a very similar setup to mutual fund. The REIT fund manager will invest into income generating real estate. Now, this income generating real estate is a very important word. It means no under construction project, no fresh acquisition. It's a project which is not only completed but also leased out. So it's income generating. Now, moment it is income generating, there's a regular monthly income which is coming into the portfolio. 90% of the net distributable cash flow, and we'll come to those things a little later, goes back to the investor. So now essentially what happens from a layman's perspective, 4 things are met. First, he could work with a very low ticket size, which could be in thousands, not even lakhs. Second, this is listed on the stock market. So at any point of time, he wants to liquefy this, it's on a button. Number 3, the ticket size being low, it being listed, offers him the flexibility to diversify this into as much as he would invest into a fixed deposit or a gold.
Okay.
And the fourth and the most important parameter, the governance over here, the transparency over here is such that he knows in and out about where the money is put, who are the lessees, and how is the fund performing, and if he wants to switch, he can switch at any point of time.
Okay.
So that's REIT for you in a nutshell.
So you mentioned that do all REITs have to be listed?
So in India, being associated with SEBI is a mandatory criteria.
Okay.
And which is why being listed comes natural. And in fact, that supports the purpose of bringing liquidity, transparency, and regulation. Because SEBI is strongly associated with regulatory framework. Moment it's listed, it brings liquidity. And because you are listed, it also brings transparency.
Yeah, because in the US, REITs can either be private or public or not listed.
You have two kinds of REITs which are actually not listed. One is your private REIT.
Yeah.
Those need not be registered with the SEBI equivalent. So in US, you have something like a Security Exchange Commission. They need not be registered over there also. You have a second, which is public REIT, but which is non-traded. So public non-traded REITs, as they are called. So while they are registered with SEBI, but it's more like a private placement. India, we should keep in mind, is a very nascent market when it comes to financial instruments. And which is why SEBI has taken a very pragmatic call of keeping it listed with SEBI. Asset classes also to start with was only office space. Slowly we have retail. So, we'll come to the REITs that we have, etc. And thereafter, now you have the SM REIT. So we are taking baby steps, but the steps which are very firm and which is going in the progressive direction.
Got it. So right now, I'm aware of 3 REITs. There is Embassy REIT, there's Brookfield, there's Mindspace. Embassy, I have some investments in. Is there anything else? How do you distinguish between these 3
So I'll tell you. Good question. So REIT market is a 86,000 crore market in terms of valuation.
Okay.
36 today.
For the
market cap. And there's a fourth one.
Okay.
So today, the largest REIT in terms of market cap is the Embassy REIT, where your money is, which is 36,000 crores.
Okay.
It's also the largest REIT for office space in Asia in terms of the square footage that they've built.
Oh, wow. Okay.
It's a very interesting REIT. 74% of their portfolio is from Bangalore, where we are.
Correct.
And the balance is in Mumbai, Pune, and a little bit in NCR. So it's very focused on Bangalore as a micro market. But
all the REITs are very focused in a specific market, right?
So your second REIT, the second larger REIT, rather I would say, which is a 20,000 crore REIT, which is your Mindspace REIT. Now, Mindspace and Embassy both were backed by Blackstone. Mindspace, the developer part is K. Raheja. Mindspace has a very focus around Mumbai and Pune market. So they are, of course, they're also in Bangalore, Chennai, Hyderabad. But the focus predominantly is in Mumbai and Pune.
Okay.
It's a very conservative REIT. And if you ask me from a long-term perspective, especially people who are fans of debt instrument, this is a great REIT to have in your portfolio.
Okay.
It has a very stable long-term outlook. The third largest is actually not the Brookfield.
Okay.
So there is a very interesting REIT called Nexus India Select. Now this is the first REIT which is backing retail asset classes. So what they call as 17 urban centers. And this is across India. So in all the 4 zones, north, south, east, west, Nexus is present. They have 10 million square foot in their portfolio.
Okay.
And this is the first REIT which is focusing on retail assets, which is a big thing, because the first 3 REITs which actually got listed were all focusing on the office
spaces.
This REIT is the one which is really to be looking out for, because the way consumer behavior pattern is shaping out, this REIT is associated with more than 3,000 brands. That's the touch point that they have. Malls, especially grade A, are doing really well across, because there's a phenomena of YOLO, you live only once. So people are really going out over there and buying, and not only reliant on your online purchase. The fourth REIT is the Brookfield REIT.
Okay.
What's interesting about Brookfield REIT is, unlike the first 2, which is your Embassy and Mindspace, this REIT is not backed by a developer. This is a fund which is actually controlling it.
Okay.
Otherwise, you had the Embassy developer, you had the K. Rahejas.
Yeah.
This REIT is purely backed by the fund itself. this is in a short-term perspective, I would say this is the most promising REIT, given the way they are acquiring assets, given the way they are growing. Also, with growth comes a bit of debt. So that is something which is of concern. Debt in India, given the way inflation and repo rate is a little expensive. So those are long-term concerns. But they are really acquiring assets quite a lot, very heavily focused on NCR. So all your three REITs are actually focusing on different micro markets, which is so nice because in a way they are very micro market focused and they are looking at that very specifically with expertise. So these are your four REITs, so to say, which are public listed, and between them they really control about 86,000 crore. They contribute that to the market cap, which is roughly about $10 billion in US terms. Now you'll be amazed. World's largest REIT, Prologis, California based, is $120 billion. Wow. India REIT market cap is at 10 billion. A single REIT of US, Prologis, is $120 billion. Wow. Now that's a huge number. So something which is larger than the entire country. True. The most populous country. And you will be amazed what asset class they are in. They are in logistics and industrial. So we've so far looked at only office space. We've just started looking at retail asset classes. We've not explored warehousing. Our consumers are purchasing products which are coming from warehouse. Exactly. So I was going to ask you that. So all your Amazon. But Nexus would not invest in warehouses as well, because I mean that can be classified as retail too. So what presently they've done as a strategy is there were so many malls. The success of a mall is single ownership. Unfortunately, a lot of malls in the country were sold on strata and they failed miserably, because to run a mall successfully, the ownership needs to be centralized so that services are well maintained, the brands are well maintained. Running a mall is an art in itself. That's why you don't see a lot of people being able to run mall successfully. True. Nexus understood that there aren't even 5 good mall operators which are national, and they sort of got into that. But that is the tip of the iceberg. What is really lying in the pie, and I believe strongly that your SM REITs, your fractional ownership players are going to really hit hard on, is the warehousing piece. The warehousing piece is so large and it is growing like how. Today, if you were to map the private equity investments in India, 20 years back, they wanted to back only residential. Then they moved to commercial and malls. Today, almost 70% of your private equity investment is looking at warehouses. It's a very simple asset class. Land is what you need. You need good roads. You need highway connectivity, and a shed is all that you have to build. There is no fancy approvals, no fancy, cost to actually sort of do the interiors, etc. It's basic racking. And the operating cost is so low, because an office space which would say cost you 100 rupee a foot, a warehouse will come at 15 rupee a foot at 15% cost, which is hardly 20 kilometers from the city. So these other REITs, so Nexus, like you said, invests only in malls. They do not invest in warehouses, even though it's a retail-based REIT. So presently their focus has been on malls and a little bit 354 keys they have. So 1 or 2 hotel properties. But they've principally looked. So for example, in Navi Mumbai, there is a Seawood mall which is there, is something which is Nexus owned. They have malls across 14 cities. So, and what they don't call it malls, they actually call it the urban community centers. So UCC is the jargon that they've put up. It's a very interesting REIT, and I strongly feel that they are actually in a niche where no one else is presently. But are they limited to invest only in like any of these REITs, right? Like, let's say, can Embassy invest in warehouses if they want to? Are they limited because of the way they've set up their No. So Nexus also has an Embassy flavor over there.
Okay.
So Tim Holland, who is, the chief operating officer, is also on the Nexus board.
Okay.
So Nexus is backed by Blackstone. So there is Embassy Blackstone also operating over there. Just that this Embassy Office Park REIT was focused on office parks. This is more for your community centers, what they call.
So let's talk a little bit about how a REIT is set up, right? The structure of a REIT. Now, let's say that you have in a REIT, you have the concept of a trust. I mean, you have the concept of a trust, which we spoke about, right? The unit trust, which is really the financial structure that where mutual funds also use. And you have the concept of a sponsor, you have the concept of a manager. So how does all of this come together? What's the role of a sponsor? What's the role of a manager?
Spelled it out. So it's a 3-layered piece. You have the sponsor to start with. So before a REIT is actually laid out or it goes public, the entire REIT starts with a sponsor. So that's the company which actually incepts this. Next, you move on to forming in the format of a trust.
Okay.
So trust often owns a holding company, and the holding company owns an SPV. So it depends on how the REIT would like to lay it up. So the SPV at times, to make it tax efficient, to sell, buy, assets are laid out over there. And then multiple SPVs are brought back to a holdco, like a holding company. And the trust owns the holding company. So that's how it lays out at the trust end. And then finally, you have, your managers. Now, managers are essentially of two types. One, you have investment managers, which will look at the growth part of it, which will look at the day-to-day operations, ensuring your ratios are in place, ensuring that vacancies are not there, etc. Basically running at an efficient REIT. You have the second important managers, which are more like your property managers. They are essentially the facility managers. And this is so important. I mean, you build the best of complexes, but in 2 years, they look at least 30 years old because they're not maintained well. So facility management is at the center of this entire REIT business, especially the office park REIT. And this is so not well understood because maintenance or management of a property for us is actually internal to your premises. So we never think of common area maintenances, be it the homes that we stay or the office we work. We always look at it that once you enter my office or home, it has to be the best. But we don't think about the common areas. And that is really where REIT makes a difference. Facility management is so very important. And corporates today are preferring that. REITs which are spending well on, the common area experiences are actually doing much better as compared to. If you observe, more than 50% of the lessees, the companies paying rent, are from the technology and the financial services. So if you have 50-60% of the rental income to all these REITs, which are market capped at 10 billion US dollars, coming from these two, and these two sectors are very heavy on human resource. So you need to provide to them that ecosystem. So it's not about brick mortar office space. It's about that food court. It's about those slide experiences, the commute, so many other things besides the office itself.
There's also just managing the tenants and the tenancy agreements and all of that, right? Rent collection. I mean, we do property management here itself, so I know how much goes into it.
It's really difficult.
So all of this is done by the facility manager or a combination of the investment
So investment team actually looks at that part, which looks at the growth as well as the existing properties. Facility manager is much more focused to the common areas.
On the maintenance and all of that. Okay, got it. Now, there's also the concept of schemes, right? Because a REIT can have schemes and the schemes own the SPVs. So is that the case even for the REITs we have in India, or they just have a single scheme right now?
So, of course, the way REIT works, you have a larger trust and they keep growing their portfolio. At times, even by acquisition. So inorganic growth is a lot. So, it's not necessarily that an embassy and a Blackstone will get together and only build assets. They might just acquire readily built assets which they feel are coming at a good valuation. And they've done that quite a bit as well. So once that happens, essentially you need to, and each asset will come with its own history, with its own baggage. So the best thing is to, really parcel it off in an SPV and then bring it back to a trust or a holdco structure. So multiple SPVs then plowing back themselves to REIT is a very acceptable structure even within India.
Okay.
In fact, this was one of the major reason why, in spite of REIT getting introduced in 2004, could not even see or be tabled for discussion till 2014, and your first REIT actually hit somewhere around 1790.
Yeah.
You had InvITs which were tabled after that, but they were operating.
Now that's my next question. So what is an InvIT? How does that compare to a REIT? And now recently I heard of something called a seit. Okay, so how does this REIT compare with this?
So I'll tell you, to make things really simple, REIT is real estate driven. This real estate could be office, it could be malls, it could be warehouse, it could be a hospital, school, any real estate, any income generating real estate. Now you have infrastructure. So you have roads, highways, telecom projects, bridges that gets built. You get regular toll income from those.
Okay.
So IRB is India's largest InvIT. They have 12,000 kilometer single lane under their management.
Okay.
So basically, all your express, and the way our government is focused around creating connectivity, having a multi-city corridor, industrial places, this is the best way in which it can work. And it's so long lasting. InvIT will have a far larger life by nature of it being infrastructure. And this is at times backed by the government also. So there's a lot of support over there from the government.
Yeah.
Now, an interesting concept is around seats.
Yeah.
So seats are sustainable energy investment trusts.
Okay.
So SEIT is basically, there's a lot of thrust on solar energy, wind power, and to develop assets which can generate these.
Okay.
So very interestingly, recently Mahindra's as well as Canadian Pension Fund, so the Ontario Teachers Pension Board, along with Mahindra's, they got together to put up a 1400 crore seat which is there, and this was the largest anchor for this was AIB, so Asia Infrastructure Investment Bank, which has put around 465 crores in this. So almost 1/3 investment has been backed by a single player. That is how promising this is. So what basically they are laying out is the solar energy. You keep hearing the Prime Minister talk about the importance of solar energy and harnessing that.
Okay.
And there is so much gigawatt requirement that seeds are now gaining importance.
Okay.
And seeds go really well in achieving your net zero target, in achieving carbon neutrality. So that's how they're working well.
So right now, are there many InvITs and seeds?
So InvITs, yes, you have about 22 InvITs which are running presently. The number can be far higher for the kind of country that we have. But unfortunately, a lot of InvITs are also reliant on the macro environment, which is the political situation and the backdrop to the whole thing. Hence, it's not really picked the way it had to, in spite of it being they're listed even before the first REIT got listed.
Got it.
Your seats have just started picking up.
Okay.
I see a very promising future in terms of seats, and there is a fourth variant, which is SIT. So SIT is actually Sustainable Investment Trust.
Okay.
So while sustainable will look at not only large scale projects, so it will not look at a Mahindra and a Canadian pension fund. It will really put up a fund which will further give money to small scale players who are operating into sustainable energy. So that fund is, and that's $1 billion fund which is looking to come up, a very promising one, which will really go across the nation to support these small scale players. So it's very interesting way in which this entire investment financial market instrument is getting used to map it to real estate, infrastructure, sustainable energy.
Very interesting. So now you said that the REITs invest into income generating assets, right? But they can invest about 20% into non-income generating assets or under development assets. Is that correct? So 80% has to be income generating.
So the idea is that REIT also has its own set of expenses.
Yeah.
You have the maintenance charges to be paid, you have the fund manager charges, the trustee charges, custodian, paperwork, facility, etc. So the distribution, which is 90%, actually happens not from the rent that comes, but the net distributable cash flow which is available,
which is income minus your expenses. Exactly. And whatever's left, 90% of that has to be distributed. Why not 100%?
So 90% is the minimum. And the reason that a lot of fund managers like to keep a buffer is for a rainy day. If there are vacancies which are there, if they want to grow, they want to service debt, etc. Market keeps a track on how much distributable income is being generated out of a REIT on a consistent basis. So this becomes a very important criteria about how much yield the REIT is actually generating.
Yeah.
Which is why this particular marker is extremely important.
But we'll come to the calculation of this. But what can the remaining 20%?
So 20%, basically the idea is how the yields of the REIT can sharpen out.
Okay.
Now, REIT is competing with a fixed deposit. We jumped from a 4.5% repo rate to 6.5%, and how every 2 weeks the finance minister was coming and announcing a 25 bips raise in the repo rate. This kind of interest rate rise affects very adversely to the REITs.
True.
Because suddenly you have that investor saying, if my bank is giving me
guaranteed
a fixed deposit at 7%, why will I put into a REIT at 7%? So, which is where REITs, in spite of it being such a promising concept, 97% of US is into REITs, but India, the penetration is below 20%. This is the reason. And hence, to sharpen that opportunity, the idea is that you allow the 20% as a growth flexibility. Now, this 20% can be put into liquid assets. So liquid assets could be the T-Sec bonds, it could be some deposit, something which is liquefiable.
Oh, it doesn't have to be real estate.
Exactly. So you could put it into liquid assets. You could also put it into real estate. But the idea is, if you're going to put into under construction real estate, be mindful of forgetting that money for the next 3-4 years at least, because you'll have to contribute, let it develop, then let it get leased, then let an IPO come out, and then you will yield. So that's a very long short story. So until and unless within the SPV gamut you have another asset which you want to support, like for example, an embassy REIT is developing 5 million square foot of another REITable asset class. So they might want to put a part of this REIT fund into that particular asset, in a way becoming an investor to that particular REIT. But more often than not, surpluses are actually put into liquid assets, so that if vacancies are there, they can still maintain their track record.
Okay. So just comparing, like, you had compared a REIT to a mutual fund, right? And so when I buy a mutual fund, like let's say I buy a few shares of a mutual fund now, that is traded in the primary market. I'm actually getting that, my units from the fund house, right? Today, when we buy and sell any of these REITs we spoke about, that is actually trading on the secondary market. Is that right?
Exactly. So these are close-ended in nature, right? So by close-ended, what happens is you have an IPO, you have the fixed number of units which are getting, so the ones who picked it up at that time picked it up, and thereafter it generates a secondary income, a secondary market. Now, this secondary market is so very important because more often than not, the first question of the investor is returns, but the second question of investor is exit. Instruments which don't have an answer to exit have failed miserably. Listing is that answer. So a healthy secondary market which gets created due to listing is actually proving to be a boon for the investors to stay liquid. I mean, every investor wants to have an exit at some point. For that matter, Blackstone wanted an exit out of its own REIT, in spite of it backing the Mindspace, backing the Nexus, but still they wanted an exit out of the largest REIT. So, every investor wants an exit. Makes sense. For that, the secondary market is so critical.
Is important. That's true. So also compared to a mutual fund, now they have their expense ratios, they have like their exit loads, right? Does a REIT have similar,
Yes.
is the revenue model similar for a REIT as well?
Of jargons, this works slightly differently. I mean, you won't look at, the PE ratio, or you won't look at the EPS, which is your earning per share. You won't look at the margin ratios. Here, the set of ratios that you'll look at will be different. So the first and very important marker is the net asset value, the NAV.
Yeah, the NAV.
The NAV of the REIT is so important. It's declared annually. At times, it's declared biannually. How far is your market price from the NAV really, is a very important marker for a lot of financially prudent investors to look at it.
Yeah.
The second is your WALE, WALE. So, weighted average of lease expectancy is the full form. Now, WALE actually indicates that till how many years you will have consistency of rent and when is the vacancy expected. So, if an average WALE is say 7 years, means till the next 7 years, either there is a lock-in or you are rest assured that there won't be a vacancy over here. Third and a very important criteria is net distributable cash flow. The higher the better. So how much cash flow does the REIT have after incurring all the expenses that they had to, and now they can give that particular dividend or give that particular income. A few non-jargonized, non-technical ratios or markers that I would like to say as a typical businessman or as a typical investor. Where is the money of the REIT getting invested?
Yeah, so these are all ways in which I would compare multiple REITs and see,
exactly,
how do I, which one works best for me from a return.
If I'm very bullish on Mumbai or Pune as a micro market, I would not look at a Brookfield REIT which is focused on NCR. I would not look at an Embassy REIT which is focused on Bangalore.
Yeah.
If I'm very bullish that under construction is the right way forward and real estate market is for a upstick, I would be looking at a Brookfield REIT because they are investing a lot of money over there.
Yeah.
If I believe that tech, IT services are the ones which will grow, then I would be looking at a Mindspace REIT. So really, what is your objective will determine where you want to go. Next important piece is, if 100 rupees is being made by my REIT, who is the contributor to that 100 rupees? So if 70% of this is coming from tech and finance, and God forbid if something goes wrong in those sectors,
absolutely. So
the
there's
whole
also
REIT
a
is for
risk.
a
There's
toss.
also a risk component that we have to look at. But
So
before
how
that, I
diversified
wanted
it
to
is?
understand how does the REIT make money, right? So when we were talking about the expense ratio, that is how the mutual fund, that's a revenue model of the mutual funds. What is the comparative revenue model for the REITs? Do they
So it's
also have
simple.
an expense ratio? What is the industry average? If so, is this regulated
On an
by SEBI?
average, 2% to 3% is an acceptable norm.
So they do have an expense ratio.
Yeah. So in a way that how much, but these are expenses which goes towards annual fund management.
Okay.
And that across all your financial sectors, be it portfolio services, mutual funds, like an AMF, like an annual, charge that the fund would take. So that's a very acceptable norm, and that's basic. I mean, that would go. But what is more relevant is that given that expense, maybe between 2 to 3%, that the REIT is charging you.
What is the limit by SEBI? Is there a limit?
So there is no defined limit where they've put a ceiling onto the whole piece. But by and large, any fund would not like to be an outlier. So they would play on that piece. But what I would be more keen to look at is that given that I'm getting charged 2 or 3%, what is the fund manager actively thinking, or is it just a passive investment he's made?
Yeah.
Okay, that this asset is built, now let it run, and one fine day after 7 years, 10 years, or is he active about, okay, this is the square footage where I'm under construction, I'm putting money, or this is an asset I'm acquiring? What is he doing to shake that NAV up?
Yeah.
So I would really look at that. The way REIT makes money is really majorly through the lease incomes that they get.
Yeah.
And if they're able to really rise up their rentals and maintain that consistency, automatically the share price will go up. So remember, every 3 years, there is a 10 or a 15% increment.
Yeah.
In a way, your REIT portfolio has to go up by 10 or 15% every 3 years, assuming there isn't much of a movement on the interest rate side. So REIT makes a lot of cash flow from these incomes that come. Second, there's something called as mortgage REITs. You don't see a lot of that in India really, but you have M REITs which are there.
But mortgage REITs are like your debt mutual funds.
Exactly.
Right?
So they will put money, not even like debt mutual fund. It's essentially like how you look at a NBFC. So they would do a lending on a mortgage based security. The security could be real estate. The interest income that they get becomes the income for the REIT. Now, essentially, because you already have the NBFCs and AIFs and all your funds which are pretty much in place, you don't see a lot of mortgage REITs. Thankfully, you don't see a lot of these REITs coming in play. REITs themselves borrow at an average of 7%. So if some REIT is actually borrowing at say 7.5%, that's a big markup.
Yeah. So coming to that, I mean, I think we are going very fast, so we can just sort of take it step by step. But we were talking about the NAV, right? The net asset value. Now, how does a REIT actually value their assets, and how do they do it in an unbiased fashion? Because I mean, as a REIT, you would want the valuation to be as high as possible, right?
So I'll tell you, these valuations should also be taken with a pinch of salt a little, because in a way, if I'm paying the valuer and I'm asking him to get it valuated, is of course there is a conflict of interest. But to be fair to the 2014 SEBI gazette that they have around REITs, it mandates that every year, in a way, you got to change the valuer. So the one who's valued the property for this year doesn't have to, value it the next year. So you have to change that. So the idea over there was to maintain an independent thought process. And to be fair, it's a good thought to have a valuer, but how many valuers have the ability to do this? I mean, you don't have hundreds or thousands of valuers. And ultimately, they might be just rotating. So I would really say do your own assessment when it comes to the valuation of an asset. And it's very easy. Today, you have the best of tools available. You have companies like Lysis Forest, CRE Matrix, Prop Equity, which are giving you the price per square foot. It's very simple. When you look at the price of a share of a REIT, you know how much money is invested, how much rents are coming. So you will get a back of the envelope calculation that at what price per square foot are you investing into that. So for example, if you know a particular micro market in Bangalore is not worth more than 30,000 a foot. But by virtue of it gaining a lot of rent, if you're buying an asset at 35,000, a second part of your REIT is your capital appreciation. So you will not make money on the capital appreciation. You might just make some returns. So if you have to make money, if REIT has to make money, it has to be a culmination of rent and capital appreciation which is built in. And for which REITs are allowed to sell their assets also. So at times they take an exit too.
So we talk about how that happens. So the dividend yield, right? Like how is that exactly calculated? So what is the denominator? So all the rents that is coming in.
So what you'll do is exactly. So you'll get all the rents.
And the
you'll subtract all the expenses.
The rent is given out as dividends, right? I mean, the rent minus your expenses is
that becomes a net distributable cash flow, and that is
paid
used
out as dividends to the shareholders.
And what you'll do is you'll divide the number of shares which are there to arrive at that NAV. And NAV becomes an annual exercise which the REITs, so it's more like the book value.
So the dividend yield is dividend divided by the
the number of shares.
NAV. I mean, both are divided by the number of
shares
units,
ultimately.
Right?
So, when you get that dividend yield percentage, I would dig further deeper into this, that at what rents is this dividend yield and whether is it sustainable. Because today maybe someone might be at an upward curve. The lease has just got renewed and they are at that fourth year where you've seen a 15% jump. But whether is it sustainable or will that lead to vacancy of that tenant?
But the dividend yield is again a dividend per unit divided by NAV per unit.
Absolutely.
Or is it the issue price or the market price per unit? How is this dividend calculated?
No,
the denominator is always the NAV.
NAV is a very important number so far as your markers go. It works very similar to your mutual funds. Because mutual funds also, and in fact, this whole thought process behind REITs is modeled from mutual funds. And that's why you see a lot of these jargons like fund flow from operations, net distributable cash flow, expense ratio. All these are actually legacy of your mutual funds.
So you mentioned that a REIT can decide to invest in a new property. They can decide to sell an existing holding. How does that affect the NAV? How does that affect the unit holder? So let's say I own some shares
big
of
time.
REIT.
So something as basic as if an asset is being sold, I have looked at that asset and I've entered in over here.
Exactly.
So at what price is it getting sold?
And also it's in your NAV, right? Your calculation of NAV contains that asset.
Exactly. And plus this is going to bring capital gains and which is taxable to me also. So similarly, any kind of sale, whether it is an asset sale or whether it's a sponsor level sale, which is happening in the case of your
Embassy,
Blackstone and Embassy, that's a little concerning from a perspective. In fact, sponsor level change is more concerning because you don't know who's going to be the new owner, what is going to be the philosophy, how is it going to get managed, etc., etc. So I think very, very important that when a sale happens, and sale also remember is not so frequent an event, because how many times you have a buyer who's going to buy a 500 crore or a 700 crore asset? It's a very limited buyer set and it's a rare event. It's not something which you will see usually because it's a big ticket
But
sale.
how does it affect the net asset value? So suddenly you have like let's say a 10,000 crore REIT and they divest 1,000 crores, so you're left with 9,000 crores.
So NAV in a way will shoot up because the income to the REIT has shot up because of that divestment. So suddenly you have a large corpus. Your shareholder numbers are still the same. So you've added another income bucket in a way.
They put that money into a liquid fund and it still stays as part of.
Correct. Now, how this asset sale is happening is also important. Is it part of some shares which are getting swapped? Is it part of pure money being paid over here or some units getting transferred? So NAV is also dependent because remember the denominator is important in deciding the fate of the NAV. So sale of the asset, a rare event, not so usual, and which is why, and it's real estate at the end of the day. So you won't find every quarter or every year a buyer who wants to buy 1,000 crore asset. So if someone's taken a position, and which is why it's so important that what constitutes your REIT fund. Because if the fund has taken a position of 1,000 crore asset, they're pretty much married to that for a long time. And if it's not a good location, if it's not a good, that's going to push your entire portfolio, and which is where SM REITs brings a fresh lease of life.
So we'll come to that.
That changes the game.
But let's say that the REIT wants to buy another property. Let's say Embassy wants to buy something, right?
They do it all the time.
How does that happen? How does that work?
So
how
what they do is,
and can they raise capital? I mean, can they take a loan?
They can take debt.
They can take
so
debt.
For example, the cost of borrowing of Embassy is around 7%, 7.2%. So they raise money, and there is something always a ratio which is called as LTV. So loan to value ratio. So as compared to, say, if your REIT is of 500 crores, how much loan are you raising? So something which is shy of 25% is considered a healthy ratio.
Okay.
So if you have 100 crore worth of asset, you could borrow up to 20-25 crores.
Okay. Okay.
The servicing of this will happen from your net distributable cash flows any which ways. So the
that
income
brings
so
it
in
down.
a way that affects your dividend and your reserves or whatever further you'd want to do.
Okay.
But mortgage is pretty much a part of
real estate
real estate. So, like any investment vehicle, REITs would like to raise, and which is why if there's a good, strong sponsor, there's a good, strong brand, merely a change of name from, say, an India Bulls to Embassy could make a sea of a change. So if that asset was owned by Embassy, suddenly the valuation, the perception, because now it'll be maintained well. Now there'll be a fresh lease of life which will be put in.
True.
And which is why I always say the REIT is not only about building REITable assets. It's also about taking good assets at good locations at a good valuation.
Yeah, absolutely.
And if you get that, why not raise capital and do that instead of actually building? Because that cycle of building is almost 10-year cycle. Because you acquire land, you make the building, you get the completion, you lease the asset, you go to public. So it's a 10-year cycle.
Can you, if they want to buy another property, can they go IPO again? Can they raise?
So that's like a FPO, like a follow-on public offer.
Okay.
So if they want to increase and make it more open-ended, like how mutual funds or exchange-traded funds are, where they want to increase the base of the investors, they can. A lot of concurrence of unit holders is required at this point of time. So because if they take some major decisions like a sale of asset or raising some fresh capital or decisions which are more than 50 crores etc., which can have an impact on the fund itself, will require unit holders concurrence. And a unit holder has a voting right. So it pretty much works like how shares etc. work. So your raising for them or buying a new asset is pretty much part of the trade. It's or raising debt. It's not an unusual event. Rate at which they are raising is a important one. And because they have to declare the cost of borrowing. So for example, Brookfield is going aggressive in growing because it's a baby REIT fund. I mean, it's just 11,000 crore fund as compared to the market players which are at 20 and 36,000 crores. So slowly it's actually making its kitty big, but it's borrowing at 7.5%. 50 basis point on a 500 crore is a huge number. So that becomes a little bit concerning because then that'll also add pressure to the repayment obligations which are there. So one has to look at that at what rate is the REIT borrowing. Just raising funds and acquiring asset is not enough.
Got it. So let's talk about the SM REITs now, right? In fact, recently we had Sudarshan Lodha on one of our podcasts, and he was
he's a good friend.
Yeah, we were talking about the proposal at that point in
he's
time.
He's from Bangalore, in fact, I believe.
He is, yes, very much. So we were talking about it, and so was the fractional ownership platform, so many FOPs, was that the trigger for the SM REITs? Was it something else?
So I would joke around this. In India, you need a scam to happen before you have a regulation in place. So, you'll always have a regulation only once a scam happens. Because that's when the authorities wake up and they feel, okay, now we need to form rules. You look at the history of India. Any sector, anything. I mean, some catastrophe has to happen. Whether it's financial catastrophe or environmental. It's one of a pleasant surprise that SM REITs came as a very pragmatic act in place. So fractional ownership was mushrooming like chit funds.
Yes.
It was going left, right, center. Everyone and anyone was opening a fractional ownership fund. And everyone was saying it's a platform. So we are not responsible. You look at it, investment is subject to market risk, sort of a Honda. So every property consultant also started working like a fractional ownership platform, saying that I will get regular income from this as a maintenance cost, and I carry a coffer. Now this is where it became risky and crazy. Because people were floating private limited company, they were floating LLPs, they were floating PMS, and there was no regulation. It was a gray space. It is not REIT. What is this exactly then?
Company so it was law to some extent, but even that I don't think was really being followed.
So it's not even portfolio fund. And which is where I think SEBI became very proactive on this, and they came out with SM REITs. So in a way, they've institutionalized the fractional ownership part. So they are saying the sponsor needs to have a net worth of 20 crores. 10 crores of which will be a liquid net worth. I think this one criteria will knock off 80-90% players. How many fractional ownership platform holders can say that I have a net worth of 20 crores? Which is nice. Second, what SM REITs actually does is brings down the ticket size from 25 lakhs to 10 lakhs.
To 10 lakhs,
So in a way opens up the market to many more people. Now remember, REITs can come at 50,000. And fractional ownership guys were doing 25 lakh, 50 lakh, 1 crore. Now suddenly 10 lakhs became the minimum criteria.
So this is when they go IPO, then the unit can be bought at 10 lakhs.
And which they have to be within 3 years of them getting the certificate that they are running like,
But for a regular REIT, it's 50,000. But for an SM REIT, it is
absolutely
10 lakhs.
So in fact, the unit size in regular REIT is 10,000. The lot size of, one lot is 50,000. So but the disparity was that you had 25 lakhs otherwise. So now this will bring much more democracy into the entire setup. But let's say for the guys who don't have like a 20 crore net worth, can they still continue to operate as FOPs now? So FOP still now, it's become irrelevant. Now, if I have SM REITs being there, I should be really ill-informed to go to an FOP.
That's true.
Plus, my ticket size is only 10 lakhs.
True.
Also, the asset allowance here is 50 crores now. So instead of a 500 crore cap, now this is brought down to 50 crores to 500 crores. So if, for example, you want to buy a warehousing complex, which is say a 200 crore project, that could be an SM REIT.
True.
Which was a gap. Now, fractional ownership were taking advantage of that 500 crore criteria and bringing for the product. So good fractional ownership platforms will migrate to SM REITs. In a way, I say that SM REITs is a misnomer or a mistitle. It should not be called SM REITs. These are actually fractional ownership platforms, and you should abolish running of a... Now, can I run a REIT without going to SEBI? I can't.
You cannot,
So why should you even allow fractional ownership to be running? And this fractional ownership is also a jargon. If you look at any Marwadi Gujarati family, they've always bought 10 people have bought a property, even if it is 10 crores. With 10 names. So everyone owns 10%, 5%, 7%, 3%. You look
they just formalized it and made it into a platform.
They just gave a fancy word to it.
Each other, we can still, co-own
now, properties. The problem with that was when you are saying see, why for decades Marwadis and Gujaratis or some of these people ran that what you call as fractional ownership successfully for single asset. They used to buy one gala, putting some 6-7 people together because there was uniformity of decision making.
When they want to sell at the same time. So this becomes an issue of
now
exit.
With fractional ownership, my biggest challenge is I'm in a room with 20 unknown people. And the one who's running me doesn't even have a net worth of 20 crores. He's informing all of us. So this is, I don't know why are they even letting it be. So the migration should be just like RERA came. RERA did not give an option that whether you can migrate or not. Every developer has to migrate. In my view, SEBI should come out with a circular that all this fractional owner, it's like chit funds. Like, why would you want it to be operating also? It should migrate to fractional ownership, should migrate to SM REITs. SM REITs has full flexibility. This will transform real estate and how. You can now put money in warehouses. You can put money in co-living. You can put money into service apartments. You could put money into retail mall. You could put money into a small office project.
Yeah.
Only place where fractional ownership to some extent, I believe, will exist is your holiday homes, your Goa types,
your timeshare, yeah,
or maybe your co-living, co-working types where you don't know the cash flow that will come.
Yeah.
Mainly which is driven by revenue share and not by fixed rent. So fractional ownership will work there.
Okay. What is the other difference between the regular REIT and the SM REIT? Regulatory differences.
So principally, it's like one is the father and another one is the son. Like 500 crores
and 50 crores.
Here you have 50 crores.
Yeah.
50,000, so a lot, many people. 10 lakhs, so little bit of a filter over there. Promoter experience, which is required of 5 years, and with at least 2 completed projects. Here it's brought down to 2 years. The fund management experience is 5 years.
Okay.
Net worth is pretty much kept the same. So 20 crores coexist. Your holding 25% is required over there. You don't require so much of a holding when you're doing, an SM REIT. You require about 15% to be held or so.
How much is it there in the main?
25%.
25%.
You need
but that
to hold.
Reduces year on year, right?
For 3 years, there is a cap that, you need to be holding. Rightfully so, because you're dealing with such a large quantum and the players over there are very different.
Yeah.
The mandated requirement over there in a way is office space and now into retail. With SM REITs you can play around. You can do warehousing, you could do a school, you could do any asset which is more than 25 crores.
Okay.
And so they've also kept that limit from a sense you don't push them to 2 crore and 5 crore sort of assets over here.
Yeah.
You could do thematic. So you could do SEZ REITs. Now you have some notification which allows you to
denotification.
One floor also could be an SEZ. So you could play around with that. So SM REITs actually is that missing link in this puzzle to make it more flexible, more available, and more sharper. Like, I don't want to go the conventional REIT way. So I wanted something which is more playing around. So it's like large cap, mid cap.
Large cap, mid cap. Yeah, that's a fair
You
comparison.
could actually say in that sense. So SM REITs gives you that flexibility.
Little bit more risk in the mid cap than your
absolutely. So
large
the
cap,
volatility,
but more return as well.
So most of your good fractional ownership players like your Strata, your HBits, your Viz, and apologies to those whose
Property
name I've
shares,
forgotten.
there are quite a few
Share.
of them.
So these ones will migrate.
Yeah.
In fact, they are racing who will be the first, second, third.
Yeah.
The ones who just opened for the kicks of it, like pandemic saw a lot of tech platforms, ed tech, prop tech. And a lot of co-platforms, co-living, co-working. So all these kind of things will wean out. But SEBI should actually crack down on this, that you either do a REIT or you do a SM REIT, not allowed to do anything in between.
So this 80% has to be invested in income generating for the regular REIT. How is it for this SM REIT? Is it the same?
In fact, good question. 95%. So, the idea over here is that already it's in a way risky because you are looking at a 25 crore, 50 crore sort of a segment. So you are not looking at a 500 crore asset, which is more established.
Balance out your risk in a way.
So now their idea is don't put money in under construction. Focus either on liquid securities or put your money into completed projects only. So 95% is a very welcome criteria because in my view, why should you even look at something else? Because you already have a small ticket size. So might as well pick up those projects which are not qualifying. If I'm doing a nice building of say 200 crores in a micro market, I can never dream of becoming a REIT.
That's true.
Today as a developer, I can think of making my commercial project into an SM REIT.
Yeah. What about the 90% of net income that has to be distributed to the unit holders for a regular REIT?
So
In the
that
SM REIT, it's the same?
still pretty much continues. You don't
Okay.
have the margin left a lot, because 10% is any which way is a very less of a buffer. The principle, I mean, the REIT concept globally was that 90% has to go. So
Okay.
this is more like a global context to the entire
Okay.
REIT.
Okay. Okay.
REIT is there in more than 100 countries now. So,
Yeah.
it's more or less like a thought process
Yeah,
that
yeah. It's
it
come very
is.
late in India. But
You would be surprised. Pakistan had this way before
really?
us. You would be
Wow.
absolutely surprised. Saudi Arabia had this before us. Qatar
Wow.
had this.
Okay.
It's
Interesting.
unbelievable. Also, I think largely because, in these Islamic nations, they don't take interest income. So REIT makes much more sense, right, for them.
Acha, okay.
Our guys can compare interest rate, how much bank is giving and how much REIT is giving.
Yeah.
But for them, that is never a call, right?
Yeah,
Under the GCC countries,
yeah.
but Pakistan had it. So I
Wow,
was
that's like
actually
since when? How
going
many
through.
years ago did
So
they?
I think at least a decade before India had a
Really?
REIT.
Wow,
So
that's like
in India, we got caught in the web of double, taxation. So they were taxing the REIT at the entity level, and they were taxing also the dividend distribution. Now that's so wrong, right? How can you double
Yeah.
tax the same income?
Okay, so how does it work now?
So it took them a decade or more and a government to change from UPA to NDA for them to realize this,
Yeah.
that okay, we shouldn't double tax this. So
Okay.
otherwise, the money that was coming, first they were taxing it at the REIT level,
Okay.
then they were again taxing it at the dividend level. So
So
right
now?
now the taxation is very simple.
Okay.
Whatever dividend you get as per your income slab, in a lot of likelihood you would be in the 30% slab only.
So then it is not taxed. The REIT doesn't pay
Not at
tax
the
on
tax
its,
level, not at the entity level,
Okay.
unless they've opted for a minimum tax concessional scheme at the operational level. Then there is some basic 10% tax, but otherwise by and large they don't get the
Okay.
tax. The idea is that it is merely a pass through.
Yeah. Exactly.
They are
Exactly.
actually an escrow account. So why would you tax them?
Yeah.
Second is on your holding. So if you hold this for a year or below and you sell it,
Yeah.
it becomes like a short-term gain. So you have to pay some 10% tax. Otherwise, it works like a long term where you pay 15%. And for that, there's no indexation benefit. So this works very similar to securities.
Okay.
In a way.
Okay.
It's very affordable taxation regime, I would say.
Okay.
Just that it competes with fixed deposit. That is our only issue right now. And the rental yields are not really above. See, globally, what happens? Your interest rates are 1%, 2%. So even if the REIT is making 4 or 5%, it's a wow factor.
Yeah.
In India,
True.
they always battle with your interest rates.
Yeah. So, so in the US, like what percentage of real estate is owned through REITs?
96%.
It is 96%, right?
Absolutely.
I was looking at that and everyone around me was like, not possible. It cannot be 96%.
No, what is more surprising is, and this is something which you'll flip. Look at the biggest REIT, which is California based, is $120 billion.
Yeah.
Your entire Indian real estate
So this is
REIT is
commercial
10
and
billion.
residential both.
So you'll be surprised. In terms of percentage portfolio, India is 11% of the portfolio is all your office space REITs, your REITable assets are 11%. US mainly REIT is around your warehouses, and also US, you will be surprised, they have a prison REIT.
Prison REIT?
So I tell you, this is interesting, okay? So abroad, prisons in US, prisons are managed by private companies. The government doesn't manage the prison. And of course, their prisons are much more well reformed, etc. They actually look at it from a reform perspective. So the way the state pays the private company, right?
Okay.
So real estate, income generating.
You own the asset and they build on it and they pay you rent.
REIT. I'll tell you another interesting REIT, which you will completely flip over. There is a graveyard REIT.
Oh my God. Where is this?
US. This is why 96%. So I'll tell you, this is super interesting. So I came across this during my PhD research.
Okay.
And imagine, so my thesis was supposed to be India's first Ph.D. thesis.
Yeah.
The flip over was there was no material available.
Yeah.
So now we are talking all this content.
Yeah.
Embassy was not even listed.
Yeah.
So I had started looking at Singapore and UK and US market, Australia market. Graveyard REIT works on the concept. So in Hindu philosophy or our ideology, we burn the body, right? What do the Christians do? They bury.
Yeah.
For them to go to the grave is a very common thing through the year.
Yeah.
Because for them, it's about, going back to their ancestors and, sort of praying over there, expressing gratitude, putting flowers.
Yeah. Yeah.
When we think of graveyard, we have some horror movie scenes which play in our mind in India. But if you see over there, the graveyards are very beautiful. They're well maintained. People pre-book the slot they want to be kept in. So they pay a premium.
Yeah.
The families actually pay an annual charge to the graveyard for the maintenance of that part because they go there every year.
Okay,
so they actually have a graveyard REIT.
Wow, interesting.
Imagine the extent to which US has actually taken this.
Yeah.
You have prison REIT, you have graveyard REIT. Even a block of land where you have a hoarding could be a REIT.
Yeah.
Think about it.
True. Yeah.
You could set up a hospital, could be a REIT.
Yeah.
US has successfully converted all these formats into REIT, which is why majority of real estate over there, and you have a lot of pension funds, etc., which pump money into these REITs.
Into the REITs.
Because for them, this is safe.
So how would you compare this 96% to India currently?
Below 20%. So,
but even 20% is pretty good given that it's been only 4-5 years, right?
But I would say that, you have a lot of potential. Combined Bangalore, Hyderabad, Chennai, Mumbai, Pune, these markets have 50% assets which are REITable.
Okay.
If you go to Pune, Hyderabad, 70-80% assets are REITable today.
Okay.
We need to somehow come out of this mindset of selling each unit, each gala to a single guy. So if you're building a complex, go for the REIT format. And I think with FDI and FII looking actively at this segment, this will happen.
Yeah.
I think somewhere not to blame the developers, because how long will you hold? True. And how will you hold?
Yeah.
Not everyone's fortunate to have a Blackstone sitting with them from the inception level.
Yeah.
If you had that, you would build that kind of a thing.
True.
So we usually build even complexes where we've sold units at launch level or while we are building. Okay. Then they are not REITable, because then they become strata units.
True.
Which you will have to go in the SM REIT format then.
Yeah.
Like a floor plate could be 50 crores. A floor plate could be 40 crores.
Okay.
Today, fractional ownership guys are penetrating over there.
Yeah. So what do you think what happened in the mutual fund industry with so many different mutual funds and so many varieties? I mean, you want sector funds or, is that exactly what is going to happen?
Why not?
In REITs?
So see, you have residential. In residential, you have service apartments, you have condominium, you have student living, you have holiday homes, you have townships, you have plotted developments. Move to office space. You have IT,
so
you have commercial, you have SEZ. I'm coming to it. Look at warehousing. You have cold storage, you have industrial, data centers, hospitals, social infrastructure, hospital, schools, universities, colleges. You have large complexes, you have small complexes. Just like you have all these thematic mutual funds, these are all thematic REITs.
Yeah, exactly. So that's what
you could have a warehouse REIT.
Yeah.
You could have a student living REIT. You could have senior citizen REIT. You could have a data center REIT. Data center is such a huge asset class.
True. Yeah.
India made the law that Indian data has to be on Indian soil.
Yeah.
As a result of that, all your Facebooks and all these people are now forced to bring all the data here.
Yeah.
Chennai and Mumbai are so well connected to the sea, so all your underground cables, which even a shark teeth cannot sort of chew, those kind of cables are coming and landing here.
Okay.
to make a data center is so expensive. I mean, it's more expensive than the land on which it is built. Minimum tenure of a data center is 25 to 30 years.
Yeah.
Such a beautiful product for REIT.
Yeah, absolutely.
You could do a 30-year REIT on a data center.
Yeah.
So this is what we are looking at.
Lots of opportunity and lots of scope.
So one of the statistics that we were looking at, that going further, and I'll share with you a very interesting thing. 2007 to 2017, China had a hockey stick growth.
Yeah.
It rocketed. They had a 4x growth. So there's a study which says once any country crosses $2,000 per capita income,
okay,
you see hockey stick growth or a surged growth in the economy. So it has happened to Japan, it has happened to South Korea, it has happened to China.
Yeah.
India in 2024 is at a point where China was in 2007. So Prime Minister, when he says that by 2034 we'll be the third largest economy, it's just math. We've reached there, 2024. Yeah. From 2024 to 2000 in hockey, they dribble. Those were the years. Now you are at an inflection point. Yeah. And if you look at the way hockey stick is, this is the way it's going to grow. Now, and this has happened 4-5 times in the world. So, it's not the first. Yeah. Which is why from 2024 to 2034, for India to be a $10 trillion economy or be the third largest economy is just math.
It's a given. Yeah.
It's 2.4 times. I mean, it's going to happen. It doesn't matter who runs the country. Yeah. From there, now this is where, interestingly, we go towards, and they gave these Hindi names, but a developed economy, which what the Prime Minister calls as Viksit Bharat, which is your journey from 2034 to 2047. Okay. Which is where we become a $30 trillion economy. And now let us look at it from real estate perspective. Today, we are the second largest employer directly, indirectly after agriculture, touching 256 industries, right from your security to steel. You are contributing 5% to India's GDP. Real estate in 2034, when we are the third largest economy, will contribute somewhere to the tune of 10% of the GDP. Now, the amazing part is, from 2034 to 2047, when the journey actually goes to become a $30 trillion economy, real estate share would be 18%. Wow. Which means what? All these things that we discussed is actually going to be converting into a capital market. Yeah. You will have products on all of this. Yeah. Which is where suddenly there will be a glut of capital which will float. And, overnight, a scam cannot get declared into a real estate asset class. You can't have the entire building being declared it's wrongly made. But a company can fall. Yeah, that's true. A company's promoter might have some issue. Yeah. But you can't see that happening, that entire building, this is made on a playground. Yeah. So this is the story, and this is where, we are leading into. Got it. And these are just pure statistic economical numbers. Yeah. This has happened 4 times in the world. I don't see a reason why this shouldn't happen. Yeah. And we have a population whose average age is 20 to 25. Yeah, absolutely. It's a consuming population. 140 crore. Thanks to, the way pandemic shaped our systems up, we've got a digital push of 10 years. Yeah, absolutely. Today, no one's carrying a wallet. Yeah. Even plastic cards are not being carried. I know. You're doing everything with your mobile. Yeah. Your shop vendors, your lowest point is running on mobile. Absolutely. Tier 2, 3, 4, 5 is now seeing the growth. Yeah. You have Nexus put up a mall in Roorkee. Yeah. Who would have thought? No, absolutely. I've also heard amazing things happening in the tier 2 cities. Harshul, I've learned a lot. I've really enjoyed this. And, thanks so much once again for coming over and spending this time with us. Pleasure.
Hope you have been enjoying our podcast. At Property Angel, our mission is to make real estate affairs safe, simple, and efficient. And that is why we bring you these podcasts to empower the consumer so you have the right information. We are an asset management company. You can outsource your landlord responsibilities to us, including tenant management aspects, maintenance, rent collection, financial management, and all of that. If you have any such requirements, please do reach out to our team. Please do also like, share, and subscribe. If there's anything specific you would like to listen to, please do leave it in the comment box below. Thank you for tuning in.